us, and I don't have to look straight because he's not joining us on from Hong Kong or from his office. He's joining us from our studio. Welcome to India.
Thank you.
What brings you here?
So there was a
Everybody has the same question. Can you imagine?
Chandrayaan 3?
yeah. I mean, there was an investor conference only this week, and we came for that. And then this was a time to meet companies, meet the policymakers here. And I must say, it's been a good couple of weeks here in India.
Navigating the traffic.
Sorry.
I was stuck in this. This is we've had rains. There were times I was at a signal for 30 minutes complaining to my wife. But that's it.
So what's the buzz you're picking up from the conference? Is the sentiment for India at an all-time peak?
I think if we sit back and reflect on it, clearly in terms of macro policy, and this is from New Delhi, we are way much better than what we've done in the previous decades. And this is coming at a time when globally policy making is kind of deteriorated. So when you compare relatively, we may be a standard, two standard deviation above rest of our peers. And I think that is what is somewhere giving support to this market, that when you talk to the senior policy makers, they're very clear that they're willing to sacrifice near-term growth for the macroeconomic health of the country, etc. And I think things are on control. We've had strong execution on the infrastructure projects. The GST collections have been fairly robust. So somewhere that kind of provides a flow to the growth, that provides a flow to the market in this period of uncertainty. From corporate India, I think the feedback's been mixed. Banks is as good as ever. There are pockets which are doing exceedingly well, hotels, travel, etc. But consumption, particularly from retail perspective, is weak, and nobody is able to point a finger at what is the reason. Is it that the consumer is in shell because of inflation, etc.? But yeah, consumption's been a bit weaker.
But if that is the case, then why the banks are showing growth in the retail book?
So I think this is a question we all are asking. Is it unsecured loans? And to be fair, if you ask me what worries me, is this growth in unsecured loans over the last 5-7 years. And now everybody is kind of complacent about it. So one thing which would worry me about banks, and this is a space we've liked, is, look, are we going to see some of the delinquencies come through in unsecured loans? There seems to be a kind of an complacent attitude about it. We've seen RBI also come and talk about it. Hopefully regulators tighten more norms on this, but this would be a thing to watch for.
So do you go selective in banks? Do you partial profit take here, or do you add more to your portfolio?
So absolutely, the approach here is you go with conservative banks. You want to go with banks who've got strong underwriting franchises. You want to go with banks who have a strong liability franchise, but one would go conservative in the financial space here.
You know, it's been quite a deviation from the pharma space with what we saw during COVID time, pre-COVID, etc. What's the outlook currently on pharma, particularly with the expensive valuations?
So if you see pharma space, the rally happened from late May, June, when there was this buzz that, pricing in US has improved. One thing which we guys have to watch out for over the next 6-9 months is the strong deflationary impulse coming from China. See, demand's kind of been very weak post this reopening. We've seen renminbi come under pressure as China writes a blank check for the property developers, local governments, etc. And our belief is that renminbi further weakens from here. As renminbi weakens from here, the Chinese corporates see less demand at home. A lot of that material is going to come in the export markets. So pharma story looks good for next couple of quarters, but beyond that, I would be watchful, more so in terms of deflation, which is coming from China.
You did speak about, consumption as being a bit of a weak link, and some of the inflationary concerns as well persisting. So what does one do then when it comes to the consumption space as a whole? What's the advice? I think
the idea here is to buy on dips. Right now, one would be more predisposed towards consumer staples. They've got pricing power. And with this deflationary impulse which is coming, their RM costs will go down. We've already seen that in the last quarter. They've had 3 to 4 percentage points gross margin increase. The hope is ahead of the election, government gives some sops, and you will see some demand momentum pick up. Discretionary, I think, is going to be long drawn recovery. May take more than what it takes for staples, but staples over discretionary here.
Okay. So you're picking a spots in consumer discretionary. That would include autos also?
Yeah, so if you look at discretionary, there would be pockets which are doing well. I mean, and we own that in our portfolio. Examples
Luxury
would
is
be
doing
hotels,
very well,
hotels, something like a Zomato, which has been doing exceedingly well, and there's a World Cup, and I think that's it there. And autos. See, there are autos.
You can also buy Jubilant Food Works. Huh? People order a lot of pizza when World Cup matches are on.
Yeah, but Zomato gives them
But do you
option for
think
other
this
things.
time
But yeah, I think
do you think this time they'll order biryani?
people like options. Yeah? People like
As
options.
they always do, data suggests that's the most ordered dish.
Yeah.
But you know, since you are closer to the mainland, I want to talk about the China factor because you know, in all the conversations that we've had, is that India is a relative outperformer and a relative preferred bet. But relative to what is the question? And when you stack it up against China, a lot of concerns and a lot of push coming in from the government. Wanted to understand from you whether it's really working on ground.
See, I think what we've got to realize is, and this is the government is trying its best. So unlike 12 months back, where the policy making in China left a lot to be desired, we are having a policy bazooka from the government, but somehow the underlying response from the consumer is just not there. And for that, we've got to go back to history and see. And whenever excesses happen, they take their own sweet time to digest. So China needs 4-5 years to digest the excesses of the last decade. So it's going to take its own sweet time to recover, come back, etc. And I think that is what most investors are realizing. That look, in India also we are seeing a slowdown, and there is no denying on that. But this is not a structural slowdown. It's just a temporary slowdown. Give it a couple of quarters, the consumer comes back and he's going to spend on these discretionary products. And I think that's the differentiator between the two economies.
Does one need to be exceedingly selective when it comes to looking at new age tech as a space?
Absolutely. So I think that's what we've done. You would like to go with companies, obviously, who are disruptive. You'd like to go with companies who are frugal about using the cash flows. You'd like to go with businesses that have a great connect with the consumer. And hopefully, in the shocks which come every 6-9 months in the market, you get an entry price. See, your entry valuations are also very important. And it's very important for us to differentiate between a good company and a good stock or a good investment. So we do that with real estate, we do that with other things. Unfortunately, what happened because of the decade of cheap money which was in 2010s, people forgot this, and that's why people lost a lot of money. Yeah.
So you're not looking at buying power, PSUs, defense, aerospace. Those are the hot sectors.
So see, we run a ESG fund. In the ESG fund, obviously defense or some of these coal mining or thermal stocks are constrained. But look, the fund's done well, and there are so many opportunities outside that. But to your question on power, I think for the first time in June we saw those power shortages come in. And if the economy grows like this, that is going to be there. So the idea is to look at select power stocks which have a sizable renewable component also.
Let me ask you what you're buying. Tell me what you're selling.
What are we selling? See, in this market, again, what we were selling was some of these expensive mid caps. I think the risk reward is just not favorable over there. There's been a lot of exuberance on inflation peaking, consequently rates coming down very quickly, and this is something we've discussed before. Yes. Market is going to be disappointed on that. So I think our policymakers are very clear that rates come down when US cuts rates. And the differential is the lowest it's been in years, and this is where market would be disappointed by the stickiness of the rates and the growth recovery in small mid caps. And if you're looking at some of these small mid caps which are exporters, I think the pricing pressure from China would become all the more noticeable in coming quarters.
Are there any pockets of undervaluation right now in the market, or is it all froth?
I wouldn't call everything as froth in the market. Look, if you look at financials, at the valuation they are, and I would call Indian private banks as the fintech giants of the region, they're fairly cheap compared to what fintech is valued. So I think there are pockets which are reasonably valued. Parts of autos are reasonably valued. Expensiveness is basically in small mid caps. But look, the longer term growth tailwinds for the economy are so strong that one would be a buyer on these tips. So there would be kind of cyclical downturns, which would be 2, 3, 4 quarter downturns, which are small cyclical downturns in a long structural stories, and that's where we'll get good entry points for these stocks.
So let me divide your portfolio into 2 categories: 1 to 3, 5 plus. What would you like to own for 1 to 3? When I say time frame, 1 to 3 time years and 5-year plus.
Okay, let me make it from a medium term time frame, which is 3 to 5 years plus. We continue to like real estate. See, this is something we bought.
Real estate.
We aggressively bought post COVID. Our point was there's a 10-year downturn in the sector, and affordability, the best it's been. You look at the new household creation, people want these, the market's consolidated. So I would still go back and buy real estate from a 3-5 year time frame. We continue to like hospitals as a space. That is something which has done well. We've been anchor investors in the likes of Narayana, etc., Haridwar, etc., and continue to stay committed to that space. QSR is a space we like. If you look at China, something like a KFC has 8,000 to 9,000 stores. I mean, in India, you look at similar formats, it's a fraction of that. So these are the names apart from obviously the financials we have. From a shorter term time frame, I think our view is as renminbi slips, rupee would also slip. So won't be surprised to see rupee between 85, 87 over the next 6-9 months. So some of the exporters would benefit. So something like a pharma, something like IT services would benefit. Consumer staples could be good place to hide and protect.
Why consumer staples?
Consumer staples would be good place to hide and protect your capital, basically, because it's an uncertain environment. Market would correct, discretionary would be under pressure. So that's more from a defensive perspective. So that's to answer your question on what to do from a near-term 1-year perspective. But as one gets the confidence that rate cuts are happening, growth is accelerating, then you go back to those longer-term structure stories.
I'm just thinking about it that the only defensive trade in this market is that don't buy defense stocks. And some of these space stocks have gone as if, from...
they themselves are making a moon landing.
Yeah, I mean, from moon, forget moon, I think they're giving you valuations of Mars. So strange things are happening in that space, right? Defense, space,
so
government PSUs.
people like us who've been in market long enough
How
have
many years
known.
you've been?
So I started my career in July 1999. So 24 years now. Wow. So I saw the tech cycle. So I saw the frenzy where fund managers used to sell Wipro in 2003 circuits forward, because Wipro was part of benchmark.
It was not liquid.
It was not liquid. So we've seen that. We saw the infrastructure boom, where you had the likes of IVRCL,
Reliance Power issue got subscribed in 60 seconds.
Yeah.
Reliance Power issue got subscribed in 60 seconds of opening, and it was a 7,000 crore IPO in 2008. Add inflation back up, it will be bigger than 25,000 today.
Yeah. So I think we've seen that again. And look, it's very important to preserve capital. You will get opportunity to make money. And if you look at most of the retail participants, I think that's a concern I have. They like playing in derivatives, FNO, that gives them the bang for the buck. They are levered on that. Okay.
Yeah,
I think we need smart anchors like you guys to help them here. That's the only thing I'll say.
Yeah, we need smart advice from you. But since you have tracked IT for so long, tell me what's happening with IT. I mean, what is the real picture right now? There's all that AI threat, the slowdown in the sector, companies coming out, cutting their guidance, talking about weak visibility for the next 2 to 3 quarters. Is now the time to buy them?
Okay. So what's happening in IT is clearly your discretionary spends have slowed down considerably. But at the same time, your large, $1 billion, $2 billion cost out deals are happening. So somewhere these deals are coming through. See, the corporates are saying, look, there's an opportunity for us to look and revisit our processes, and that's where these large deals are happening. So these large deals take their own sweet time to ramp up, and that is where you see the volatility in the earnings. Because of this Gen AI, what happens is the pressure on whatever subcontracting costs they had, on the employee costs they had, would be considerably lower. The Gen AI gets truly commercialized, accepted by the clients in 3-4 years when they see the prototypes, proof of concepts, etc. So till that time, it's a window of opportunity for smart companies. That can they create 100,000 workforce which is competent in Gen AI and do it faster than the global majors, and they capture this opportunity. See, these companies have captured the opportunity post Y2K. They captured the opportunity post cloud. It is all about being nimble and creating a large trained workforce in the technologies of future.
So who could do that?
I think the bellwethers, the likes of Infosys, TCS, are well positioned to do it. Yeah. Of course, there are smart younger companies also, mid-cap companies also. But there's a lot of good talent in the sector.
Yeah, they seem to be embracing this opportunity quite well. What about sectors that are undervalued in the markets currently?
So honestly, one's got to think very hard to find something which is undervalued. Look, it's a well-discovered market. I think financials, large private banks, or to an extent somewhere, the large caps which have underperformed are where one would take some money out of mid-small caps, to Nikun's earlier question. That's what we've been doing, to take money from small caps, mid caps, and put it in large caps. So
I go back to that basic template of IT, and something which we are debating and discussing with everybody. let me divide the IT space into two: bread and butter business and the AI business. The AI business is disruptive or not disruptive, I don't know. Only time will tell us. But then there is a bread and butter business which is slowing down. So one leg of the business is up, one leg of the business is down. It's like a seesaw, right? In that seesaw, how much long do you think markets will take to price them? Because terminal values will change.
See, what happens here is, look, the slowdown's been evident for last couple of quarters. It came with Infy's kind of a reduction in guidance in April.
Like somebody dropped a bomb.
Yeah, so it happened, and to be fair, on ground it started happening for these guys from March onwards, basically. So somewhere the sector is also under-owned. Okay. So the price momentum in the sector has not been as much as other spaces. And look, these companies been around for 25 years, so we've got to give them some respect for being able to navigate the different ups and downs of the business cycles. The free cash flow yields are good. They are good capital allocators. So I think market will give them benefit of doubt here.
What about super specialized IT companies? We've never had this kind of a range in India, whether it's in MapMyIndia or to some extent InfoEdge, some extent I would say Latent. There are a lot of these specialized SaaS-based companies which are now getting created. You like that space?
So honestly, we've not done much work on those companies. They are the likes of KPIT, etc., which comes specifically on that. Valuations kind of expensive. So one's been watching that, but one needs to get more conviction because these are very usually a single vertical company. You're not aware of the disruption which is going to happen to them. So there's a fair bit of a volatility or inherent risk in the business model, and you're not adequately compensated for that in terms of the valuation. See, the valuations are not 15, 20 times. The valuation for most of these guys would be 45, 50 times plus. Yeah.
Which is the hottest sell-side idea right now, and which is the hottest buy-side conviction idea right now?
See, I don't really look at this. You look at the sell side for the inputs which come through, but I've never really worked on the hottest sell side.
You sent everybody, they whispers, which you pick up at the conference. We've been attending so many of them, and you come back and you say, that was the number one idea at this conference. You may act, you may not act. That's
I think what came out was people were fairly interested in hotels. That's a category which is doing well, and clearly there has been a huge amount of underinvestment in the sector, similar to real estate. You've seen demand momentum pick up, economic momentum pick up. So I think that's a good space for next couple of years.
I was entertaining a guest 2 days ago at one hotel, and 2 cups of cappuccino costed me 700 rupees. That's pricing power or inflation, I don't know. But that's why you have to pay for a cup of coffee to a good hotel. Can I get you a coffee?
Not from the canteen, though. Pleasure having you in our studios. Thank you so much for coming by and sharing with us your insights.
Thanks for having me, guys. Thank you.
Thank you very much.